Let's get the latest business news now. Joining me is Evan Lucas, Chief Market Strategist at InvestSmart. Evan, good morning. The market is heading for a fifth straight day of gains. When could we reach last year's record highs?
Good morning, Danica. It's not far off. We're about 3% away from what we saw on the absolute eve of the pandemic. So February 19th last year was our record all-time high, and it's about 7,100 points. So we are not far off that at all. The way we're going to get there probably mid next week, and nothing seems to be slowing it down, despite the fact that there are some hesitations, the fact that we've obviously now seen JobKeeper come off, whether or not we start to see some data that suggests that we're going to slow down consumption in this month, because we probably will see around about 100,000 people now classified as unemployed rather than employed, with them off JobKeeper. But everything in the market at the moment is to the upside, because everything we hear at the moment is that the economy, not only is it good, it's growing, and that the support in the economy from things like central banks is not going to be taken away anytime soon.
And speaking of the central banks, there's been a lot of talk overnight that the central banks will let their economies run hot. What are the risks to this, do you think?
Yeah, this is the big debate. So we saw on Tuesday the IMF come out and say that they actually believe that what's going on right now globally is the right thing, which is that central banks, as you alluded to, Danica, are all having either record low interest rates and some form of quantitative easing program, or of that respect to what they're doing. They're basically saying don't stop with where we are. And we saw last night the Federal Reserve, in their minutes from their meeting a week and a half ago, suggest that they're not going to touch their rates till 2023. On Tuesday here, our own RBA said that they're not likely to touch our rates till 2024. As you said, though, there are risks. We know about housing, and I'm not going to really talk about that much more. I think what really needs to be highlighted in terms of risk is the actual behaviour that it creates. So the level of debt that we currently have as a nation is obviously going to get higher. That's not necessarily a bad thing. Debt is a tool. It's how we're using it. And I think that's the real key, is that the asset prices outside of housing, things like going into risky loans, things like going into ventures that actually aren't necessarily productive, which is what we normally use in our world, is getting higher. You're also starting to see that realistically we're using speculation. So the amount of leverage that people are using in markets, in business, in everyday transactions is also getting higher, which is because they know they can borrow at such cheap rates. So yes, it creates this hot activity, but there will come a time where not only does rates go up, but we will start to slow down in our overall economic activity, and that debt will become a problem, that serviceability will become a problem. So there is this push-pull factor, and there are certainly risks for probably not this year, but next year when we do start to slow down, that all of a sudden we can slow down a lot faster as people start to realise that they're actually holding levels of debt and servicing of that debt that they can't actually sustain.
All right, it'll be interesting to see how that one goes heading into next year. Evan Lucas, thank you.